Hey guys, welcome back to the Wall Street Bull. Anthony here. I hope you're all doing well and staying safe out there. Big shout out and thank you to every single one of you who have subscribed to the channel. I really appreciate it. Thank you very much. If you're new to the channel, make sure you smash the subscribe button down there. Turn on that little bell notification as well, because as you can see right here, I love documenting my journey with investing with cryptos, dividend stocks, growth stocks, talking about passive income, building financial freedom. And yes, my goal at the end of the day is to build generational wealth. So come along this incredible journey. It's been insane so far. Also, if you can give this video a thumbs up, watch it straight through, it would really help me push this channel out to a lot more people, because the YouTube algorithm is absolute magic when you find, ladies and gentlemen, do that. All right, let's get straight into it. Little disclaimer, I am not a financial advisor. Please do your own research and due diligence. I do not want to see anyone get financially hurt. That is why my number one golden rule is I only invest what I can afford to lose. And yes, we don't like to lose. You can lose money in any kind of investment, so please be careful out there. Do your own research and due diligence. This video is for educational and entertainment purposes only. All right, ladies and gentlemen, the formalities are out of the way. Today is a dividend stock video update, giving you an update on my portfolio. Again, I purchased 3 ETFs, which I've seen a lot of comments in my videos over the last few months. And of course, I finally did purchase these 3 stocks last week as well. So they're pretty risky stuff, but they're very different in terms of monthly passive income. But I'm going to go through them with you all. So here we go right now. This is Stake, where I buy obviously all my stocks right here. This is my brokerage in Australia. There is a referral link below for Stake, so please feel free to use that. You will get a stock in Dropbox, GoPro, or Nike. Either one of those. So please feel free to do that. Of course, do your own research. But here we go right now. You can see my entire stock portfolio in the United States is at $37,370.71. Now, of course, it's down at the moment because there's a lot of macro stuff going on at the moment around the world. As we all know, inflation's going up. Stock prices are all over the place because, you know, markets are all over the place pretty much. But again, I've had a pretty insane return, and that is because of insane market drops that happened in 2020. Again, I've had a total return of 18.72%, which is $5,892.81. And of course, because the markets are Monday to Friday, not like crypto, Monday to Friday, on the day on Friday, I basically had a total return of 2.36%, which was $860 USD, which is really, really nice. So before I get into it, I purchased these 3 ETFs for one reason, and that is monthly income. Now, I've watched a lot of other influencers and a lot of other videos on this, and of course I've done my research on them. They are not particularly good for growth. For example, if I was to purchase ticker symbol VOO as an example, which is an index fund or an ETF, it is an ETF, that is specifically meant for growth. So for example, the dividend yield is at 1.59%. You can see right here. I currently hold 0.6 shares, 0.69, call it 0.7 shares of VOO, for example, but I've had a 23% return on this. Now, again, this is obviously because this got an extremely low dividend yield. However, the growth of this is insane. But for me personally, I'm heavily wanting to start focusing on building as much monthly income as possible. And of course, these 3 ETFs, and I'll go through them now, are these ones right here. So let me bring this up. This is the Global X ETFs right here. So basically, there was 3 that I purchased, which was QYLD. You can see right here. Let me load this up now. This is the NASDAQ 100 covered call ETF right now. So basically, it provides insanely high dividend yields and income. Now, I just want to show you this now. I'm going to bring it up to show you how high that dividend yield is. And there's a reason for that. You can see right here, $17 a share, but 12.56% dividend yield. That is basically the annual dividend yield, but this pays out every single month, which is really nice. So QYLD seeks to generate income through covered call writing, which historically produces higher yields in periods of volatility. When the market is obviously quite bullish, these tend not to do very well. When they're extremely bearish and volatile, these will do very well. So monthly distributions as well, has made monthly distributions for 8 years running. And of course, QYLD writes call options on the NASDAQ 100 index, saving investors time and the potential expense of doing so individually. Now, obviously, the NASDAQ, historically doesn't pay dividends because they're tech stocks. A lot of tech stocks, for example, like you buy Tesla or Nvidia or all these companies, they pay very little tech stocks. However, QYLD and Global X are able to pay dividends because they're writing covered call options right now, which again, for those of you who do not know what that is, and I actually had to look this up myself. So basically, what is a covered call? You are entitled to several rights as a stock or futures contract owner, including the right to sell the security at any time for the market price. Covered call writing sells the rights to someone else in exchange for cash, meaning the buyer of the option gets the right to own your security on or before the expiration date at the predetermined price called the strike price. So a call option is a contract. Obviously, that gives the buyer the legal right, but not the obligation, to buy 100 shares of an underlying stock. Obviously, you need to have a minimum of 100 shares, by the way, or one futures contract at a strike price at any time on or before the expiration. If the seller of the call option also owns the underlying security, the option is considered covered calls, because they can deliver the instrument without purchasing on the open market at possibly an unfavorable pricing. Profiting from covered calls. That's basically what it is. So the buyer pays the seller of the call option a premium to obtain the right to buy the shares or contracts at the predetermined future price. The premium is cash fee paid on the day the option is sold and is the seller's money to keep, regardless of whether the option is exercised or not. A covered call is therefore the most profitable if the stock moves up to the strike price, generating profit from the long stock position, while the call that was sold expires worthless, allowing the call writer to collect the entire premium for its sale right now. So again, basically someone has to sell, for example, Tesla, 100 shares of Tesla, and they're predicting that it's going to go up to like, $1,000. If it doesn't hit that strike price right there, basically they don't have to buy it. And the seller also keeps the premium as well. So that's my understanding of it. But again, moving on, QYLD for me, again, is an investment to generate that monthly income. So again, this is based on the NASDAQ. Now, the other one here that I want to show you as well, which was XYLD, which is the S&P 500 covered call ETF as well. So reasons to consider: seeks to generate income through covered call writing, which historically has produced higher yields. XYLD has made monthly distributions for 8 years. So covered call options on the S&P 500 index, saving investors time and potential for doing that themselves. So again, this is based on the S&P 500 now. So S&P 500 is obviously all the big boys in the stock market pretty much. So again, the other one here was QYLD, XYLD, and RYLD, which is the Russell 2000 covered call ETF. So again, pretty diversified in this. So this seeks to generate income again through covered calls, paying on a monthly basis. So again, writes call options on the Russell 2000 index, saving investors time, blah, blah, blah. So again, the expense ratios on these are quite high because they are actively managed. So somebody and the company Global X are actively managing these ETFs as well. So just let that obviously, be part of your due diligence with these ETFs as well, because, when you look at the expense ratios, for example, SPHD or VOO or VTI, they are quite low because they're obviously automatic, moving stocks in and out of the ETF based on the dividends and so forth. But again, these RYLD, XYLD, and QYLD, are actively managed by people. So again, they're charging a premium to produce these call options. Anyway, moving on right here, ladies and gentlemen, of course, QYLD. These are the ones I bought, so I'm going to show you right now. Let's have a look here, ladies and gentlemen. QYLD, I bought 15 shares of this. My average buy-in, again, was $17.34. I've made 1.61%, which is $4. But again, I'm focused on that 12.56% dividend yield. Again, in the last 3 years, this has not performed quite well. It's pretty much just, again, that high dividend yield. So, for example, if you're looking for that income, something to consider, obviously. The other one is RYLD. Let me scroll down to here, of course. There's a lot of stocks right now. RYLD, I purchased 12.9 shares of this. Average buy-in was $20.30, of course. It's now $20.50. Basically made $3. But again, 12.73% dividend yield, which is really nice. And of course, XYLD, which is the other one. Let me scroll down here. This is right at the bottom. This one's priced a little bit higher, obviously, $42.79 right there. And of course, 10.8% dividend yield. And I've made a total return of 1.23%. But again, it's generating 10.8% return, which is really nice. Okay, so basically, this is it. This is my entire portfolio. Of course, I've got my big dividend stocks right here, which are ExxonMobil. You can see right here. $86 a share. It's down today, obviously, but I've had an insane return of 73%. I've got 105 shares of ExxonMobil, which pays quarterly. Look at that dividend yield there, 4.13%, so it's quite low, of course. My other favorites, obviously, are SPHD, which again is a monthly dividend-paying ETF. Let me just scroll up here. This is one of my biggest holdings, by the way. This pays a dividend yield of 3.73%, so it's quite low, but this has had growth, which is nice. $44 a share. I currently own 120 shares of this, and I've made 9.5% on my investment, $466. So again, this is basically getting the best of both worlds, growth and monthly dividend income as well. But on the charts right here, you can see it's had a 5% return on the 3 years. On the year, it hasn't been doing too crash. Month as well. On the week, though, it's up 3.72%. But again, really nice for that monthly income as well. Of course, Realty is another one I'm looking to buy more of, which is a monthly dividend paying REIT. Again, another monthly stock, 4.37%, $69 for Realty as well. It's up on the day, 1.76%, 5.71% on the week. And on the month, it's up 3.7%. Look at that nice V-shaped return recovery right there. I've got 35 shares of Realty, 26% return. I made $521 of my money. Can't complain about that. What else have we got here, ladies and gentlemen? Of course, EPD is another one I'm very bullish on right now, and it's quarterly dividend pay, so you get paid every quarter. Let's have a look here. $23 a share. This is a midstream company that provides, services for managing gas and so forth, and transportation and petroleum and petrochemicals and all that stuff. 7.88% dividend yield again, which is in the range that I like. Very different to QYLD and so forth, but this has made me a total return of 2.61%. Obviously, I've got 83 shares of EPD, and again, it provides me some nice income right there. But let's have a look at my dividend tracking app. Okay, so you've got $2,107 of yearly dividend income. This is in Australian dollars now. It's paying me $175 a month. Obviously, me purchasing those 3 ETFs literally jumped up my dividends per year by $158. Again, I believe that's going to compound and just keep growing, which is crazy. Let's have a look here. My top 3 dividend payers are ExxonMobil, SPHD, and EPD as well. And if you can see here, ladies and gentlemen, ExxonMobil pays me $534 a year, SPHD $281, EPD $224, Realty is $153, AT&T is at $138, Prospect Capital is $108, VYM is at $91, and of course Stag $62, which is a monthly dividend payer. Here are the 3 ETFs right here. You can see $58 a year, $53 a year, $45 a year. The way I see this is I know I'm not getting the growth, but I've got my diversification in my portfolio, which is very important. I'm diversified in all my growth stocks as well, and obviously quarterly dividend paying stocks. That's why I'm not too concerned about it. But again, this is going to help me build this portfolio a lot quicker. This is what my goal is right now. So let's have a look here. I've got a goal of $100,000 a year in dividends. Again, I would need to invest $2.1 million to receive $100,000 in dividends a year, which again would just compound like crazy. It would snowball. Now, if we go to my portfolio in Australian dollars, again, there's a lot of macro stuff going on. $53,000. I've had a $7,300 return, 15%, which is nice. And I love doing this at the end of the video. Let's have a look here. I'm going to keep scrolling down right now. Okay, so this is the timeline right now. So this is based on a 5% annual dividend growth rate, which again is not something that QYLD, RYLD, and XYLD are going to do. Basically, all that's doing is generating cash flow. But these other stocks in my portfolio are going to be insane. So let's have a look here. 5% annual growth and 2% annual stock growth. So if I go to 10 years, my portfolio would be worth $98,649. If I don't reinvest any more of my own money and just simply reinvest the dividends, again, this is crazy. It will generate me $6,910. Now, if we go to the 20-year marker, which is ridiculous, this is basically how Warren Buffett and Charlie Munger made all their money later on in life. But in 20 years, the portfolio is now going to be worth $316,000, and it will generate me $38,000 a year in income. Now, that is just insane right there. Basically, that's just about $750 a week from those 3 investments, and me reinvesting all my money back into this, like dividends back into this portfolio. That's what it will generate. So I'm starting to see the snowballing happening right now. I am seeing that with ExxonMobil, with SPHD, with EPD, with AT&T. This is the beauty of dividend investing. So once you start to see that snowballing effect, it becomes a lot easier. And the market for me, anyway, I've seen a lot of other dividend investors say that once you hit your $100,000 mark, USD, things become a lot easier and they start to snowball a lot faster. So this money right here, as soon as I get dividends paid out next month, that's going to go up. And this is the beauty about compounding interest as well. So who doesn't want to earn $38,000 a year, $750 a week? I'm sure a lot of people would as well. So this is the beauty about dividend investing and why it's very important to start earlier, because the longer you are in the market right now, the more you will benefit. So if you're young, have a look at it, do your own research. And of course, if you're older, you know, like myself, obviously I've got, 34 years old. Again, I need to start looking at higher dividend yields because I need to start generating income a lot sooner as opposed to waiting, 30, 40 years to get that growth. Again, so I started later in life and I wish I had known about this earlier because I would be absolutely a millionaire right now. Anyway, that's pretty much it for my dividend stock portfolio update. And again, I did buy those 3 ETFs, which have basically put me up in terms of bringing in more income for myself. But let me know in the comments below if you have any questions about it. Love talking with everyone. And again, please feel free to use the referral link below for stake. Obviously, do your own research. Of course, this is not financial advice, but hope this has brought something different to the table than crypto. But I'm very diversified with my investments. Again, I've got my stock portfolio. I've got my crypto, real estate. I've got another investing platform called Raise as well, which is Australian. Basically, it takes up roundups, and I've been doing that since I was, years ago. So that's nice as well. So very diversified. I think that's important, not just solely rely on one asset. But again, if my cryptos take off as well, they'll be going straight into this because this provides serious income consistently, and that's generational stuff right here, what you're looking at right now. So let's talk in the comments. Stay safe. We'll speak to you on Monday. Peace, bye.